What's up YouTube? Dougie Chong here. Welcome to today's episode where I'll be going over 5 stocks to buy here in November of 2020. First off, I'll mention that I'm in my new studio, so I apologize if it's a bit echoey. There's not much furniture in here yet. Also, please leave a like and subscribe if you have not already. It really helps my channel to grow. I'll try to make one of these top 5 videos every month just to give a feel of what stocks I'm looking at each and every month. At numero uno, we have Enbridge stock, which deals with transporting and processing natural gas and oil. A lot of you Canadian viewers may recognize Enbridge from your gas bill that you get each and every single month. That's a recurring revenue stream that the company gets every month regardless of how the economy is doing. It's not like people can just opt out of using a furnace in the winter. Here in Canada, you would freeze to death. Well, just look at the 1-year stock price history for each of these stocks, since we have a lot of stocks to cover, but it's down quite a bit from its 52-week high of around $57 and just a little bit above its 52-week high of $33. They pay a hefty dividend of 8.5%, which is absolutely phenomenal. As long as they can keep paying this dividend, this stock will make you 8% per year, even if the stock does not go up at all. Compare that to a savings account which pays less than 1% per year in interest, and you can see why it's more important than ever for the average person to start learning about investing now. I personally bought a few shares of Enbridge at around $37 per share, and I will continue to buy more if it continues to be around its current price point of around $38. This stock is probably one of the safer stocks I'm going to mention in this video. That's because the demand for natural gas and oil is not going away anytime soon. Second up, we have Dropbox stock, or ticker symbol DBX. For those of you unfamiliar with Dropbox, they offer file sharing services in the mysterious cloud. Any company that was related to cloud computing or cloud storage, just had cloud somewhere in its business model, has absolutely taken off in recent years, except for Dropbox, which has actually gone down since its IPO. The main concerns with this company is that the product is very similar to other competitors, with Google Drive and Microsoft's OneDrive being the primary threat to completely wipe them out. These are very legitimate concerns for the company Dropbox, but all these competitors have been around for several years now, so I believe there will always be some loyal followers who will always stick with Dropbox, even if Google Drive and Microsoft OneDrive offer similar products. They recently acquired an e-signature company called HelloSign, which should provide a recurring revenue stream as the e-signature business grows. Nobody likes the process of printing out forms, then scanning them, and then sending them back. It's a lot easier to just use e-signatures, and it's only a matter of time before more processes, more of these big companies start to use e-signatures as opposed to the old-fashioned ways. That's why companies like DocuSign have absolutely taken off, but its market cap is somewhere north of, I think, $40 billion, and Dropbox, which owns an e-signature company, has a market cap of only about $8 billion. The 1-year price chart for Dropbox is relatively flat. It goes from about $18 up to about $23, and now it's back around that $18 region again today. I'll note that all these screenshots were taken on Thursday, so they might be a little out of date, but luckily for me, the price did not move too much for any of these stocks in the past day or so. I bought a few shares of Dropbox for an average price of around $19 and will continue to buy more of this stock if it continues to drop. Third up, we have Alibaba. Alibaba is one of the premier names when it comes to the e-commerce space. And not only do they own the popular website Alibaba.com, they own other smaller websites such as AliExpress as well. This is the first company in this video that is green over a 1-year time span. That's largely because the shift to everyone being indoors has spurred the growth of the online e-commerce industry a lot faster than it already was growing. This change was bound to happen anyways, but the pandemic just really sped up the process. The main concerns with this company are that they are located in China. This is good because it allows them to have the cheapest prices for a lot of the products that they sell, but it also leaves them susceptible to the whims of the local government. The stock recently dropped from over $300 to around $260 today, just because the founder, Jack Ma, said some disparaging remarks about the Chinese financial regulations. And this founder, Jack Ma, does not even run the company Alibaba anymore. He was trying to IPO a new company called Ant, which was completely taken out by the Chinese government. And that action alone really negatively affected Alibaba's stock. So as long as Alibaba remains one of the biggest players in the e-commerce space, this $260 price point simply represents a discount. Its market cap of about $700 billion can be seen as low when you compare it to Amazon's over $1 trillion market capitalization. Of course, as I will comment on further in the next stock on this list, Amazon makes a lot of their money and a lot of their profits from Amazon Web Services, which Alibaba does as well, but not as much. I do not currently own any Baba stock, but I would definitely look to start a position sometime in the near future. Fourth up, we have another e-commerce stock and my personal favorite stock of all time, Amazon. I've made a few videos about Amazon stock in the past, and they are most commonly known from going from an online bookstore to an online everything store. The tangible difference in Amazon that I have seen as opposed to other delivery services is how much they have really mastered the logistics system. When you deliver with other companies, the packages are almost always delayed, but when you deliver with Amazon, you get your packages at a fairly consistent time. Their estimated date is pretty accurate, and sometimes the packages even come before the estimated date. They found a way to turn e-commerce into a subscription service and made a ton of profit from Amazon Prime memberships. I also have to mention that a lot of their profits come from high margin sales of AWS services, that is Amazon Web Services. Amazon Web Services is what a lot of tech companies use for their cloud computing needs. A company is only as good as its employees, and as an engineer, I know that Amazon has more than enough capable engineers because they can offer the best compensation package out there. Amazon is the biggest position in my investment portfolio, and I picked up 2 more shares recently at a price around $3,000. I really would not bet against Amazon since analysts have called them overvalued time and time again just to be proven wrong. I first bought shares of Amazon a little under $1,000, and at that time I thought that was expensive, but I did have the thinking that it could at least go over $1,000 in the next few years. The stock has far exceeded my expectations of just a little over $1,000, and I can see the stock reaching about $4,000 in 3 to 5 years. That represents about a 30% gain from today's prices. Over the past year, the stock has nearly doubled, which might lead a lot of people into thinking that it is overvalued. But over the past 5 months or so, it has stalled around $3,000, which is as close to dropping as Amazon usually gets. I missed my chance on buying Amazon when it dropped from $2,300 to about $1,700, so I couldn't really afford to miss this opportunity again. Last but not least, we have the very good food company for stock number 5. And unlike the other stocks on this list, this is the only one that would be considered a small cap company, as they only have a market capitalization of around $350 million. This stock is actually more of a watch than a buy for me. That's just because the price of the stock has recently quadrupled in about a year. And it's not like a lot of the fundamentals of the company has changed. It just recently had a lot of good publicity from reviews from financial education YouTubers such as Financial Education. There's not much to say about this company other than the fact that they make great plant-based meat alternative products, and they're a good alternative investment to Beyond Meat stock. Since it is a small cap stock, It has a lot of risk going forward, but can also pay a huge reward. And their biggest challenge moving forward is going to be proving that they can do what they currently do now at a much larger scale. I do not currently own any of this stock, but I would like to start a position in that mid $3 range, or preferably even a bit lower. That's it for this video, guys. Thanks a lot for watching. Let me know what you guys think about these 5 stocks in the comments below. Again, remember, I am not a licensed financial advisor and this is not legal financial advice. But be sure to hit that like button and subscribe if you have not already if this video helped you at all. Enjoy the rest of your day and see you in the next video.